Good afternoon, everyone online, YouTube, and Zoom. My name is Jason Mackey. I'm the Director of Programming and Campaigns with the Wisconsin United Methodist Foundation, and glad to have you here for our Clergy Tax Seminar. And I will introduce our presenter here momentarily. His name is James Tarp, EA, and did want to let you know that on February 3rd, via Zoom and in person at Cargill United Methodist Church, we're hosting a workshop called How to Reach Out to and Welcome New People. We're going to be focusing on how to get to know your neighborhood, not only through one-on-one conversations, but through demographics. I will be focusing on how to raise money for new ministry that you may not have in your budget, so you can support and start new ministries like that. Just go to the website wumf.org/upcoming-events, and you'll get all of the information there. So I also want to take a moment to introduce to you the president of the foundation, Crystal Goodger.
Good afternoon, everyone. It is wonderful to see you all. I am so happy that you took some time out of your day to learn all of these wonderful, important intricacies of taxes. Not fun, but necessary and needed. So whether you are in the beginning stages of being a clergy and you need to know what information you need to save, or if you are maybe a person who is working for the church and you need to understand a little bit more about clergy taxes, or maybe you are a person who is about to retire, we're going to celebrate that, woot woot, or are already retired, we are here to help you in whatever way we can. So we do welcome you here. Again, if you are visiting us through Zoom or on YouTube, we also want to make sure that you know that you can ask any questions you wish, so that are pertaining to taxes.
Yes.
You can always call us, of course, for any of the other questions, but ask us the questions that you wish. Jason will be manning the Zoom questions. And for anyone who is on YouTube, I will be on YouTube. If you're looking at your YouTube screen, so my computer's right here as I'm looking at it, there on the right-hand side, there is a section that says chat. On the right-hand side, it'll say show chat. So if you just click the show chat, you can type in your questions there, and I will make sure to raise them up to everyone here. So please make sure that you don't leave this session with questions, because if you call me with tax questions, I do not know the answer. And also, we do understand that clergy taxes are a unique niche, and when you go looking for a clergy tax personnel, just look around. They do exist. We understand that they may be a little fewer and farther between, but they do exist. So call around your neighborhoods, etc. So make sure that you're looking in your neck of the woods, because I'm sure they exist in your neck of the woods. So I am going to pass it off.
Great, thank you. All right, everybody, thanks for joining us today. My name is James Tarp. I am here to teach you about taxes today a little bit, specifically related to being a pastor and kind of the ins and outs of that. So a little bit of background on myself. I have been doing taxes for about 8 years now. All 8 years, I've really had an emphasis and a specialty in clergy returns specifically. I've been doing this seminar for a couple of years now as well, so I'm sure many of you, if you were tuned in last year as well, be a familiar face. So today, For this session here, planning is largely going to be based around individuals who are working. So this is for pastors who need to know how to calculate their income tax on their return, their self-employment tax. We kind of will go over both sides of that equation and kind of help you sort through that. One thing I will also encourage every year, as you have questions, type them in the chat. Jason will let me know if anything comes up, and I would love to kind of just field those questions as they come along. So, all right. So I kind of already went over some of this stuff, but we're gonna first go over the specifics to kind of clergy taxes. In addition to that, though, I'm also just going to give you some bonus tax tips that don't necessarily relate to clergy, just in general, good things to be aware of. Questions along the way, and obviously we're going to have fun, right? So, all right, well, we get to jump right into it this year. So I'm just going straight into it, and we have to remember that for clergy, we kind of wear two different hats the whole time, okay? We kind of hold one hat as an employee, and then we wear another hat as a self-employed individual. So as an employee, left-hand side here, we see clergy are employees for income tax purposes, okay? So for income tax purposes, clergy are employees. So what are kind of some of the defining features of that? That is going to be, you're going to get a W-2, okay? Oh, did you need? Yeah. Yep. No, you're good.
Thank you. Oh, we'll share.
There you go. That was the right one. Yeah. Okay. So employees are receiving a W-2, not a 1099. Almost always, I would say like 99% of the time, because there are some instances where you could get a 1099, but that is very rare. So if you're getting a 1099, I would immediately say, wait a second, is this right? That's a question over and over as you look at all of your documentation. You kind of just want to make sure everything's correct. So W-2 is what you should be receiving. You're going to report your income on your normal 1040 form, not on a Schedule C. So a Schedule C is where you would put self-employed income, but that's not where we're putting this, okay? One little piece that, and we'll come back to this as well, but the Tax Cut and Jobs Act in 2018, I believe it was, 2017, 2018, kind of eliminated the ability to deduct unreimbursed expenses, okay? We'll circle back to this because you are still able to deduct them on certain parts of your tax return, but not for income tax purposes, okay? Some of the other benefits that you get for being an employee that you wouldn't if you were self-employed. Yep, go ahead, Jason.
Got a question. Will you get a 1099 from a funeral home if you've received more than $300 directly from them in honorariums?
Yes, most likely. It depends on the arrangement with the funeral home. The same could go for weddings, depending. But funeral homes are the more common one where you would get a 1099, and we will cover how to report those on the return at a later point. So, yep. Yep, they will also get a 1099 for moving expenses if you move, and we'll also cover how to report that on the tax return. So, some of the benefits I just like to point out, since you're an employee, you receive a lot of really great benefits. Pre-tax flex plans, that's medical flex plans, that's the ability to have an HSA in certain circumstances. Pre-tax medical insurance is provided for you, available for you. UMPIP contributions, so contributions into a retirement account. Accountable reimbursement plans, that's going to be accounts that are set up to help reimburse your professional expenses. We do always want you keeping track of what you're spending above and beyond that. Come back to that a little later as well, but anything that you're spending on professional expenses, make sure that you are keeping track of. And then the biggest one, the one that gives us all the headaches and why this is such a complicated tax return is the housing allowance or parsonage allowance, okay? Which, yes, it creates some headaches, but let's remember this is a very, very big benefit that you're receiving, okay? For Social Security and Medicare tax, kind of refer to it in a couple different ways, but Social Security and Medicare tax are also referred to as self-employment tax. So when we talk about that tax specifically, now we're putting that other hat on and saying we're self-employed as members of clergy. So Social Security and Medicare tax, just to give you a little bit of a background on how this is paid, it can be paid in basically two different ways. Okay, one of them is if you were just normal employee, regular employee, not a pastor, okay, it's just going to be deducted straight from your paycheck, and it is going to be paid partially by you and partially by your employer, okay? So the total tax is 15.3%. You're going to have 7.65%, which is deducted from your pay, and then the employer is also going to pay in 7.65% as well. The nice thing about if you're a normal employee like this is that you don't even have to think about it. It's just taken out of your paycheck and it's done. You don't have to do any calculations. You don't have to think about it at all. And you're probably familiar with this from if you have a spouse that's working or if you had a different job prior to getting into ministry. However, if you're self-employed, all of a sudden we have to do the tax calculation ourselves. Okay, the tax is calculated on the personal tax return and then it's paid along with the rest of your taxes. So we come up with a calculation of how much is your income tax, how much is your self-employment tax, we put them together, and that's the total tax that you have to pay at the end of the year. The tax doesn't change, it's still 15.3%. However, self-employed individuals, who's the employer in that circumstance? You are. You're both the employee and the employer. So you kind of get the burden of you have to pay both halves of this. Okay, so while the tax itself is not higher, it is higher for the for clergy because or any self-employed individual because they have to pay both halves. Okay, so just kind of getting into the calculation of specifically how do we come up with, you know, how much of your wages are subject to income tax. So once again, we're just focusing on income tax on this slide. Okay, so in order to come up with your wages for income tax, we would think that it's relatively straightforward because you're given a W-2. And at the end of the day, you just take the number that's on your W-2 and say, hey, this is what I'm going to pay tax on. I like to play a little bit of devil's advocate here because I always want us to know how to do the calculation so that we can verify that the W-2 is in fact correct. I do see, and maybe this is my personal experience. I was actually talking to someone who also did pastor returns recently, and he kind of gave me an answer of saying he rarely sees a W-2 prepared incorrectly. And I was like, I had to second guess myself because I was like, well, do I just have a bad experience with these? Because I see them prepared incorrectly quite often. And so it might have been a couple things. It might have been that he was just lucky. It might have also been that he wasn't actually manually going through and checking the figures where he was just saying, yeah, there's numbers in the box. I assume the numbers are correct. That's what I don't want us to do. I don't want us to just assume that the numbers are correct. So in order to calculate it, we start with your gross wage. Starting with your gross wage, this is your total compensation here, total salary. We're then going to subtract off all pre-tax deductions. So pre-tax deductions are going to be how much did you put into the UMPIP account, into the pre-tax UMPIP account? How much did you put into a flex spending account, into an HSA account? Okay, anything that qualifies as pre-tax in the benefits that you've been given, we're going to subtract that off of your gross wage. Then we are going to subtract off the designated housing allowance. So the important clarification here is, and I know churches sometimes do it a little differently, where sometimes they'll say, okay, you have a wage of 30,000 and you have a housing allowance of 20,000. If that's the scenario, when I say gross wage, I'm talking the 20 and the 30 combined, kind of put together, starts us with 50. And then we're subtracting off the housing allowance of 20. You could just skip that step entirely. As if you're starting with 30, okay, don't subtract the 20 off of the 30. It was never in your gross salary to begin with. So just be kind of cautious on making sure you're starting with the right number for gross wage there. And after you've subtracted that off, you report that in box 1 of the W-2. Okay, box 1 of the W-2. So every year I just encourage you, when you get your W-2, look at box 1 and go through this exercise of kind of backing into this number and making sure that it was reported correctly. And that is for income taxes. So box 1 of the W-2, then you just take that directly to your tax return. It goes on one of the first lines of the tax return as far as what are your wages from box 1 of the W-2. Yep.
James, 2 things. First of all, and I've put this in the chat a few times, but we know that it's one of the challenges of doing a PowerPoint on Zoom and YouTube, that it is a little blurry. If folks want a copy of James's presentation, just email me at jason@wumf.org, and I will get that to you immediately following the presentation. Second of all, James, I wonder if you could talk for a second. Sometimes and I know you're going to get into estimating what the housing, the parsonage allowance is worth taxably. And if it's better at that time, please put it there. But if you could talk about the disadvantage of lowballing that estimate to Social Security, because that will have an effect in retirement.
Yeah, absolutely. So that is one that nobody ever brings up. So nobody ever brings up the, negative side of a housing allowance. And we will get into it more later on. But ultimately, what we're getting at here is that the housing allowance is going to reduce, how much income tax you have to pay. It doesn't reduce how much you pay for Social Security and Medicare tax, though. So really, there isn't, it would kind of be I'm sounding this out in my head right now for you too, Jason, but it would kind of be the opposite, where if you designate your housing allowance to be too high, well, I'm getting turned around in my head, but we will get into some examples to show that.
I'll bring it
Yep.
back up.
Yep, bring it back up at that point. So okay, so wages that are subject to Social Security and Medicare tax. Okay, this is that self-employment tax again. This is not going to be on your W-2. So this is kind of the real trick on the tax return, is this is the number we have to come up with. Okay, so a figure is not going to be reported to you on the W-2. It's up to you to calculate this figure accurately. So once again, we're going to start with your gross wages. Okay, we're going to subtract off all pre-tax deductions. That's also going to reduce what you have to pay for self-employment tax. Notice I also have in here, including professional expenses in excess of what you had reimbursed. So this is the area in the tax code where, when we had the whole tax overhaul in 2018, they said, hey, you can't deduct unreimbursed employee expenses anymore. But you can still deduct business expenses or expenses for self-employed individuals. And so what we see here is that since you are both an employee and self-employed, you can still deduct your unreimbursed employee expenses for self-employment tax. Okay, so we want to keep track of anything. If you have professional expense accounts of $2,000 and you max that out and you spend another $3,000 on top of it, you get to deduct the $3,000 on top of it. The important part here is do not subtract housing allowance or furnishing allowance if you were in a situation where you had a parsonage. So like I said, the housing allowance does not reduce how much tax you have to pay for self-employment tax. Okay, so we don't want to be subtracting that out. And same goes if you have a parsonage allowance, it's actually in this case, you have to add the fair rental value to your wages, okay? We'll get into calculating that as well. That's a tough question, but it is up to you. It's not up to the church that's providing the parsonage. It's up to the taxpayer to come up with a fair rental value of what the parsonage is worth and then adding that to the amount of your wages for what you have to pay self-employment tax on. So once we have all this calculation, that's the total amount that's subject to self-employment tax. You pay 15.3% tax on that, which is partially Social Security tax, partially Medicare tax.
Right. So this gets to my point. So if I have a parsonage and in reality, the fair rental value that I should be paying self-employment tax on is, let's say, $1,000.
Yes.
But I fudge and put $500. Can you talk about how that will affect my Social Security when I retire?
Yes, there we go. That's I was on housing allowance in my head. So the question before, and why it's important to accurately report what your the fair rental value of the parsonage is because if you add this to your income, that you have to pay more in taxes, but if your entire career you're only saying, oh, the fair rental value of this parsonage is only $500, you're not going to be paying nearly as much into Social Security. And Social Security, your benefit from it once you retire is completely based on how much you paid in. Okay, Social Security takes your highest 35 years of earnings, and they have a different formula behind the background, but ultimately what matters is they say, hey, what are your 35 highest years of earnings? And that's going to help us determine what you get for a Social Security benefit. So if your entire career, you're just kind of shortchanging that number and saying, yeah, the parsonage is probably worth $1,500 a month. That's what I would rent it for, but I'm just going to say it's worth $1,000 a month just so I have to pay less tax. Yes, you'll be paying less tax, but you're also going to receive a lower Social Security benefit once you're in retirement, which once you're in retirement, if Social Security is going to make up a big portion of your retirement benefit, that's a really, really big deal. Okay. So parsonage allowance, we've talked a little bit more about housing, but the parsonage allowance is a little different. So just thinking through this, when you live in a parsonage, you are effectively receiving something of value in exchange for services that you're providing, okay? So I always like to take the whole clergy aspect out of it entirely just to understand how this would be treated normally in our tax code. So if you worked as a property manager, and one of the benefits that you received as a property manager was, hey, you get to live in one of our units for free. You don't just get to live in that for free. That value, the fair market value of that apartment that you're living in, that unit, has to be added to your W-2 as a wage. The IRS says, hey, it doesn't matter if we're paying you, cash or paying you an apartment in lieu of that. It's still taxable income. Okay. So for clergy, you can exclude this value from your taxable income for federal income tax purposes. Okay. So when we talk about housing and parsonage, all the benefits are related to federal income taxes, but not for self-employment tax. So I also have a clarifier on here too. Wisconsin also is going to kind of honor anything that federal has for if you get to exclude it from your federal income tax, you're also excluding it from your state income tax. Okay. Yep.
I have a question. And I've got my microphone on, so you don't have to repeat. When preparing the W-2, should the W-2 reflect the housing allowance and pre-tax deductions in any of the boxes?
Yes. When preparing the W-2, we want to see that all of the information, basically. The more information you can provide, the better. There's a few of those which are required to be on the W-2, like pre-tax retirement contribution. That's a requirement. That has to be on the W-2. There's a specific code for it. There's a specific box it goes into. And I will go through, I believe, so I gave Jason a Word document as well that just has instructions for actually preparing a W-2, which he's, if you need that, you can reach out to him and he'll get that out to you. But we'll go through what a couple W-2s actually look like as well through this. And we'll get into that more once we get to those slides. Okay, so and the last piece, I'm kind of just saying it over and over, but the more times you hear it, the better. So the parsonage allowance, just remember, you cannot exclude the value of your parsonage, okay, from your income for calculating the Social Security and Medicare tax. It still needs to get included there. Housing allowance, okay? Housing allowance instead of the parsonage is, hey, you own your own home or you rent your own place, okay? You don't have a house being provided for you. In that case, you're going to designate a portion of your wages as the housing allowance. Okay, so at the end of the day, that's up to you. That doesn't, you get to choose what that amount is that's designated. So if you have a salary of 50,000, you can designate 10,000 for a housing allowance. You can designate 20, you could designate 30. It's up to you, and it really is going to be specific to you based on where you're living and what kind of normal fair rental value is for places in your area.
So it doesn't matter, you are quarter time, half time, 3/4, that whole time.
No, so that's a good question. The question was whether it matters, whether you're quarter time or half time or full time. That has no restriction on what you can claim for a housing allowance. So in many cases like that, I actually see if you're quarter time, I see it more likely that you're actually going to designate maybe your entire salary. That's not uncommon. So, yep, Jason.
So here's a curveball, because I know there's a few people out there working like this. So say you're a clergy from a different denomination, working as a pastor, but not appointed to that church. Can you still claim exclude a housing allowance from your salary?
So as far as as far as being eligible for the housing allowance, we typically are going to leave that up to the denomination themselves. Like that has to be in your salary package. Then it has to be a part of your agreement with the church and with that denomination, because there have to be you're going to call it something different in every denomination, but essentially you have to have like your corporate minutes at the beginning of the year where the church says, hey, we approve this much as a housing allowance. So if the other church didn't give them a housing allowance, you can't just simply say, hey, I get a housing allowance because I'm a pastor. Now, that has to be agreed upon between, in the salary package. So it could very well be something where you discuss that with them and you say, hey, I know this has no mention of a housing allowance. Is there any way that we can get that in writing in here, because I need it from you in order to be eligible for that?
Okay.
Yep, Gene.
The other thing that people get really confused on is just because the church designates a housing allowance in the church budget doesn't mean you can exclude that from your income for tax purposes. You need to have a resolution, an housing allowance or furnishings allowance exclusion resolution that is passed either at church conference or at a church council meeting. And I'm sure that James is going to go through the amount, but if you're quarter time, you can't take any more than what you're making either.
Correct. Yep. So yeah, there's lots of limitations in place. If you are, that might be, where do we see pastors being quarter time most often? In a scenario where they're also retired. I would say is the most common scenario. So there might be no. Oh, okay. Don't listen to me. So, but we'll get into different calculations because there's different ways that you can kind of, that's the whole point of this, is we're trying to make sure that you designate the right amount to make it most advantageous for you and your situation.
Yeah, I pay my mortgage more than what I get paid from the church. For example, the house for the church, my mortgage is 400.
Yep. So there's going to be plenty of situations where you are paying more in your housing expenses than what you might be receiving as a salary, just depends on your situation. If you were a quarter time, appointment, you very well might have higher housing expenses than what your entire salary is.
So now you claim all my 800?
Yep. Yeah. And in that case, you could claim your entire wage. Now, there's some other tests in place, so, and we'll go over kind of those tests. So, it's not just a open checkbook the IRS gives you of, hey, here, designate whatever amount you want. They have other calculations in place just to make sure. So, Okay. Kind of to get into a little bit of, we're talking very vaguely about, hey, here's the housing allowance, the parsonage allowance. So let's actually talk about what's included in the housing allowance. Okay. So in terms, this is not an exhaustive list, but this is going to get you the bulk of your housing. Okay. So a down payment on the home. Okay. When you buy a home for the first time, down payment on the home is going to count. This is a little bit of a trap that people fall into where they think, hey, if I have a down payment, or maybe I just buy the house in cash, maybe I buy a $250,000 house and just pay for it in 1 year. Can I deduct $250,000? Okay, there's some limitations in place, and we'll go over those. But the mortgage payments, so both interest and principal, okay, are going to qualify as a housing deduction. The important thing on the mortgage payments, which a lot of people don't realize, this is just about the only place in all of the IRS tax code where you're allowed a double benefit. Okay, through tax code, we have what is kind of called a tax benefit rule, which when you're trying to think, hey, can I deduct this? You have to say, well, if you've already deducted it somewhere, no, you can't deduct it again. You can't receive two benefits. The exception with mortgage payments here is that the interest you get to take as a housing allowance, which is reducing your federal income taxes. You also get to claim that mortgage interest on your Schedule A again as an itemized deduction, if you itemize. Okay, so it is kind of a unique area where you can potentially get a double benefit. Homeowners association dues, okay, are going to be there, whether you're in a condo dues, whether just kind of depends. Real estate taxes. So even if you have your mortgage paid off, you think, oh, I don't really have much for housing expenses. Well, you're always going to have real estate taxes, right? You're always going to have utilities. We've got utilities on here, homeowners insurance, furnishings. So furnishings and appliances. This is your initial purchase and repairs. So you got to fix the washer and dryer. That's deductible, okay? Furnishings, that could be a couch. It could be a bed. That could be blinds. That could be, anything, artwork on the walls, all that stuff. Yard maintenance supplies. So this one too, a lot of people kind of don't think through too much or just kind of forget about, but especially once you're close to having your house paid off, okay, now you're kind of scraping up, hey, what are all my expenses that can qualify, right? Yard maintenance supplies could be, hey, if you had to buy a new lawnmower, like you have to, the whole idea is what are the costs that go into keeping this house, a nice property? You have to keep it in good shape. The only kind of, sometimes when I go through this list, it's just easier to tell you what does not qualify. And that is cleaning services, personal items and food. Yeah.
So, and I know you'll get into figuring out, if your expenses are higher than what you're allowed to claim in a moment, but someone did ask, what if I make a larger payment than is due for my mortgage payment? Does the extra principal count?
So there's basically limitations in place, and we'll go through those limitations. So it might count as long as the other limitations aren't, prohibitive of that. So yeah, question.
You say we can double up on interest?
Yep.
Can we also double up on taxes?
Yes, same thing. So question was, you can double up on mortgage interest. Can you also double up on real estate taxes? Yes, you get to deduct that. You also get to deduct it on the Schedule A for real estate taxes. And Wisconsin has a credit for real estate taxes too. There's a $300 credit that you get on the Wisconsin state tax return. As long as you've paid $2,500 in property taxes, you get a $300 credit on the Wisconsin return. So you get to claim that as well. There are actually scenarios here. One of the most common questions I have, this is a little bit more for retirees, but really common question I get is, I've only got $40,000 left on my mortgage and I could just pay that off. Should I? I run those calculations both ways and it depends, but I've actually had scenarios where your tax savings are greater than the interest that you're paying each year, because that's what you have to evaluate. You have to say, how much interest are you paying on the mortgage versus how much is your tax savings? And depending on those, how that comes out, if your tax savings is greater, you're essentially getting the mortgage for free then, right? You're making money on having a mortgage. So that's a great question, but and it's different for everyone's situation. So that isn't saying it's always, you know, right to have a mortgage. Sometimes it does make sense to pay it off. But okay, so this is kind of getting into those limitations that we've been talking of all along. So how much can the housing allowance be? So left-hand side, I just say, you typically cannot designate your entire salary as housing and just be exempt from all income taxes because of other limitations. Typically, there are some cases where you can, but typically you can't just deduct everything. The housing allowance is going to be the lesser of three values. So we have to come up with three different values, and then the lowest of those three is going to be what we're limited to. Okay. Those three figures are going to be the amount designated by the church. So that's when we talk about, hey, we need an amount in the resolution from the church. We need an amount that's actually not just the amount that's in the budget for the church. We need something that's actually signed off on in the church resolution. So designated by the church. This one I also like to point out too. As long as you talk to the church ahead of time and you're not trying to do this retroactively, the church isn't going to tell you, no, you can't designate a certain amount. Okay, so this is an area you have kind of complete control over how much you want to designate. You just have to do it in a timely manner. How much is spent on housing is our second test. Okay, so that's kind of getting into that question of, hey, how much did I spend? Well, I made an extra $20,000 payment on my mortgage this year. Can I just deduct that? Okay, well, that's going to go into that figure of how much total did you spend, but we're going to be taking the lowest of these three calculations. The third one then is the fair rental value of the house. Okay, and I've got another slide just to go through fair rental value because that's determining fair rental value is where we kind of get hung up a little bit too.
Right. So I have another question. What if you are building a home or remodeling? Would an architect, builder, those bills be included in the housing allowance?
So if you are building a home, any of the costs with the construction of that home are gonna go count towards the housing. So, and it's kind of regardless of whether you're paying for it. Say you're paying for it as you go in cash. Say you're doing the whole home building process. You do a construction loan and then refinance into your primary mortgage after that. When you think through that, anything that you've paid out of pocket during that year of the build, whether that's payments you have to make through the construction loan process, or maybe you didn't have to make payments depending on how the loan's structured. But once you get into, hey, now we have refinanced into our 30-year mortgage, okay, it's just like anything else. But all of the costs, architect, like anything that goes into the construction of that home is going to qualify. Determining fair rental value. So IRS doesn't, this is one of the difficult things. It's good and bad, right? It's good because they give us plenty of kind of ability to be liberal in our calculation and kind of come up with a number that we think makes sense, but they kind of just leave it as a gray area because they don't provide any direction on it. So you're saying, hey, tell me how to do it. And the IRS is saying, well, just come up with a good number, right? So they don't give you a specific method to use to determine fair rental value. But just from our experience and everything, best way to do this is to come up with, get a letter from a real estate agent. That's always going to hold up against the IRS. If you have a letter from a licensed real estate agent saying this is the fair rental value of this property, that's the best way to do it. Now, while that's the best way to do it, I would say the most common way that individuals do it is you look at comparable housing in the area. So it could be going onto realtor.com, go to Zillow, kind of figure out what would this home rent for if I were to rent it out. Okay. One thing to keep in mind too, fair rental value, what all does that include? That includes the value of a home that is fully furnished and utilities included. So that's where it gets to be a little tricky trying to come up with this number because it's not as simple as just saying, okay, how much would this property rent for? Because most places you find are not rented fully furnished and not rented including utilities. So ways you can kind of come up with that is, okay, here's the base rent. Now, how much would it cost if I were to use a rental service or something to furnish this home, okay, and rent all the furniture in the home? How much would it cost? The utilities, you don't really have to guess too much on the utilities. At the end of the year, we know what the utilities are, right? So you can't spend $6,000 on utilities for the year and say, hey, this is what the actual expense was, and say the fair rental value of those utilities was 8,000. You know, it says, so utilities are pretty cut and dry there. Okay, getting into some examples just for calculations here. I think this is where it maybe starts to make a little bit more sense. Is in this scenario, we're going to say Pastor Ann, she owns her own home. So we're talking a housing allowance here. Okay, owns her own home. She designates 20,000 of her salary as a housing allowance. Okay. She spent $21,000 that year on mortgage payments, taxes, utilities, furnishings, and other housing related expenses. Okay. She determined that the fair rental value of the home is $24,000. So in this scenario, we're looking at 20,000 designated, 21,000 was spent, and 24 was the fair rental value. She can only exclude 20,000 from her income, since that's the lowest of those three tests. Okay, you'll come up with the three numbers, pick the lowest one, and that's the one you get the tax benefit for. So the tip that I have at the bottom here, planning, is in this case, this is kind of a worst case scenario, because the one number we had complete control over here was the amount designated. Okay. You don't really have control over the fair rental value. That's kind of just what it is. Yeah, you have control over how much you spend, but we're not going to go tell you to just spend money for the sake of a tax deduction. You know, we don't, that doesn't make any sense. So the designation of 20,000, we should automatically bump that up to 24,000 the next year. Okay, because that was the fair rental value. So if you're trying to think of what makes the most sense in terms of how much should I designate, my general rule of thumb is always designate at least what you've determined to be the fair rental value. You at least know those two numbers are the same then. One's not going to be lower than the other. So if you come up with the fair rental value first, if you over designate, you're like, say this was the scenario and then you only spent 21,000 on mortgage payments, but you designated 24,000 and the fair rental value is 24,000. You don't get penalized for over designating. Okay, it's just that the only one you just get to deduct 21,000. So the lowest of those three. This is kind of a calculation example of, we've got all the inputs at the top, and I'm just kind of going to give you side by side the difference of how do you calculate this for self-employment tax, and how do you calculate this for federal taxable income. So the federal taxable wage, that's what's going in box 1 of the W-2. Okay, so up at the top, we just look, the salary in this example is $50,000. Okay, the housing allowance designated out of that 50. Okay, so out of the 50, we designated 20,000 of housing. During the year, made UMPIP contributions of 3,500. We have medical flex plan in there of 1,200. Professional expenses in excess of the allowance given by the church is 2,300. Okay, so that's above and beyond what the church kind of gave you for a reimbursement account. And then HSA plan contributions of 2,000. Okay, so on the right hand, so the bottom right hand side, we've got calculating federal taxable wage. We're starting with the gross wage of 50,000. Okay, then we're going to subtract off 20,000. So we're subtracting off the housing allowance. We're subtracting off 3,500 for UMPIP. We're subtracting off 1,200 for medical flex. And we are deducting $2,000 for the HSA. Okay, so you kind of see the only one we're not deducting for the federal income tax is the professional expenses. Okay, so professional expenses are not deductible for income taxes. You'll see on the left-hand side, once we get there, they will be deductible for that self-employment tax though. Okay, so 23,300 on the bottom right, that's our number that goes in the W-2. For the self-employment tax, so once you actually get to your personal income tax return, okay, this is where you got to do your calculation on your own. You start with a salary of 50,000, and then we're subtracting off kind of everything except the housing allowance. So the housing allowance, you don't get to reduce that off of your income for self-employment tax. So we're taking 3,500 off for the UMPIP, 1,200 for medical flex, 2,300 for the professional expenses, and 2,000 for the HSA. So you see the real big difference is the housing that's missing there.
please?
Yep.
A lot of our people would also, if they're active, they would also have insurance premiums that are taken as a payroll deduction.
Yeah,
If the church is paying 100% of your medical, dental, and vision premiums, you can't take, it would not be excluded, but if you're paying your portion as a payroll deduction, that would be added in there as well.
correct. So the other thing too, exactly what Jean said there was if you are paying out of your pocket, you know, you're paying for a portion of those health insurance premiums, that gets deducted off of here as well. Okay, but if it's, say the church covers 100% of your premium for you, then nope, you don't get to deduct what the church is paying for you. So yeah, I tried to put a lot of different things in here. It's not an exhaustive, example, but tried to give you enough different ones, examples here. But okay, so this is kind of just showing you what the W-2 would look like then for the previous slide. Okay, so the W-2, we're looking at the bottom right-hand corner here of calculating the federal taxable wage. So box 1 is that 23,300. That's our number. That's real simple. Now that we've done the calculation, we've got 23,300. I think some of the questions we had before, a lot of the things are, okay, where does all this other information go on the W-2? And we have a instruction sheet that Jason can get out to you as well. But on the right-hand side, we're going to see in box 12, there's a code E. Code E is, and when you look at the instructions for preparing a W-2, it's going to tell you what code is for, what deduction. So code E is for a retirement plan for you, okay? Code W is the HSA contributions you made. Box 13 has to be checked that you have a retirement plan, okay? So box 12 is required. Box 13 is required. Box 14 is the only one on here that's not required. Okay, so box 14 is actually fully optional. The IRS does not require you to put anything in box 14. As someone who prepares tax returns, I please ask all treasurers to put as much information as you can in box 14, because in this scenario, imagine that housing was not in box 14. I wouldn't have any idea how we came up with the numbers we did. When I look at box 1, I see 23,300 of wages. But at the same time, the pastor's telling me that they make about $50,000. Well, how did we get to 23,000? If you didn't tell me what the housing is, I have no way to piece that together to make sure that it's correct. Okay. The flex plan is $1,200. That's another one. If you didn't tell me that, I wouldn't even know that you had a flex plan. I know well enough with United Methodist churches where I know your benefits packages well enough, but if I work with another denomination where it's not so cut and dry as far as what they have for benefits, or if you're working with someone who doesn't work with a ton of United Methodist pastors, they very well might not know what benefits are available to you. So providing all of that information just makes it way easier on your accountant to actually just verify that your W-2 is correct and that we're getting the right numbers reported. One thing in here I do like to point out, and this is in our instructions too, but box 16 is your state wages at the bottom. I just always like to clarify, box 1 and box 16 should always be the same. There's not a single example I can think of where you would ever see those being different. Okay, so a lot of times, we give all the instructions for box 1, say, hey, this is what you should be putting in box 1. And then we kind of just skip over box 16 because we just know the assumption is, okay, whatever is in box 1, just carry it down to 16 and you'll be good there.
James?
Yep.
Got a question. What about box 14 for those in a parsonage?
I think that is one of the next slides coming up.
Gotcha. So it's coming, Grace.
Yep. Okay, so this is actually an example, same exact format as what I had before, but top left hand, you'll see this is an example for a parsonage. Okay, so the previous was an example for a housing allowance. Now we're looking at it with a parsonage. So different inputs. Some of them are the same here, but we also have different inputs because when you have a parsonage, okay, first of all, you don't have a very large housing allowance. You have what's called a furnishings allowance. So you typically don't have much for expenses with the parsonage, but you still might have expenses if you're buying furniture, if you're buying, we go back to what's included in that housing allowance or parsonage allowance, either way. It's okay, that could be new, sheets for the bed. That could be pillows, throw pillows. That could be, bath towels. That could be, anything like that. Okay. So furnishing allowance in this case is $4,000. That's for furnishings, we see anywhere from, a couple thousand up to 10,000 or so. I feel like if it's over 10,000, that's, there's nothing wrong with it if that's what you actually spend. It's just, I just don't see a lot that would be that high. Fair rental value of the parsonage in this case is 20,000. That's what we said. Utilities paid for by the church, $3,000. So if the church is paying for the utilities in this case, the church should have a record of that. Okay, this is one that I see missed a lot by treasurers. This would be an item that goes in box 14, number of, what they paid for utilities. Just know you can always just go back to the church and say, hey, what'd you pay for utilities? I need that, complete the tax return. And they should be able to look that up for you. UMPIP contributions are the same at 3,500, medical flex plan, professional expenses. I kind of kept the rest of that the same. Okay, so when calculating federal wages, so bottom right, all of that is pretty much the same as what we had before. We just don't have a large housing allowance to deduct. So we start with 50,000. We subtract off 4,000 for furnishing allowance. Subtract off 3,500 for UMPIP, 1,200 for medical flex, and 2,000 for the HSA contributions. And then for the self-employment tax, we start with the 50. This is where it's kind of completely different when you have a parsonage versus a housing allowance. Okay. If you had a salary of 50,000 and you got a parsonage on top of that, okay, we've got to add 20,000. That's the fair rental value of the parsonage. So we've got 50 plus 20,000 plus 3,000. 3,000 was the utilities paid by the church. Then we start subtracting off. Okay, UMPIP gets subtracted. Medical flex gets subtracted. 2,300 for professional expenses is coming off of that, and HSA. Okay, so you'll notice in this scenario, self-employment tax, the wage that it's based off of for the bottom line is 64,000, as opposed to for federal income taxes, it's only 39,000. Always remember that the housing allowance, the parsonage allowance, like all of those benefits are all benefits to help reduce your federal and state income taxes. They're not going to reduce your self-employment tax, the Social Security, Medicare tax. Yep.
So I've got a question here, and Joseph, if I don't say this right, I'm interpreting your question here. It says, could I know what's the total percentage of tax per year? So I know income tax, and you can correct me if I'm wrong, I'm going to jump at this one. Income tax is variable, but Social Security tax is always 15.3, or self-employment tax is always 15.3%. Is that correct?
Yes, that's correct. So for federal income taxes, we have what's referred to as a progressive tax rate, meaning that as you progressively have a higher income, your tax rate will go up. Okay. So your lowest tax bracket is going to be 10%. And then as you make more, it'll jump to 12% and then 22%. When you jump those brackets, I always like to clarify this because sometimes people get in the mindset of, oh, I don't want to get a raise because that'll bump me over into the 22% tax bracket. Okay, now I have to pay more tax than what my raise was worth. So that's not the way the brackets work. The way the brackets work are that you're always paying, the first portion of your income is always at 10%. And then when you go $1 over the 10% bracket, you're paying 12% tax on $1, just the dollar that's over. Okay. So even someone who makes $1 billion, they still have, the first $20,000 they make is still taxed at 10%. You know, so it's always going to be a blended tax rate. As far as can we give you a percentage, I really wish we could. As far as coming up with a flat percentage, I wish that's how we did calculations for withholding. And I wish that instead of having this confusing W-4 where you have to come up with how many exemptions do I have, how many, you know, all these different calculations, I wish they would just give you check boxes of should I withhold 10, 15, 20% and pick a percentage. But they haven't taken me up on that recommendation yet. So what else?
He sent a follow-up question. And I'm not quite sure how to address this. Thank you. And if all of them are paid by the church, then how much would that be?
If all of the taxes were paid by the church is what I would, so yeah, so we don't have a good percentage on that. I think the tricky thing about coming up with a percentage, the easy way to do it would be to look at last year's tax return that you have, okay? And if you look at last year's tax return, there's a line on there that says total tax, okay? And that's on the second page of your 1040. You can take that as your total tax number, and then you just divide that by what your total wage is, and then manually do the calculation basically and tell the church, okay, can you withhold this much per paycheck? The part where that gets really, really difficult is I don't know if you have a spouse that's working who has different income. I don't know if you have investment income, if you took money out of retirement, if you're drawing Social Security, if you have a side gig. I don't know how many weddings and funerals you did, you know.
Well, and then Gene just mentioned, is the treasurer willing to make the payments for you? And not all church treasurers are. And so then you have to do estimated payments, and some church treasurers are. And so you do what James says is ask your treasurer to withhold a certain amount per pay period. James, can you talk about briefly? Well, my recommendation would be, and tell me what you think about this. I'll put it in the form of a question. If I didn't want to pay taxes in April, I would always make sure my estimate's a little high. If I didn't want to pay too much in and want more income throughout the year, I'd make sure my estimate's a little low and I might have to pay a little at the tax year. Is that right? And I know there's a penalty if you go too low.
Yeah, that's so we've always had anytime working with clients and preparing my own return, and everyone gets to make their own decision in terms of how accurately do you want to calculate your tax throughout the year. And I would say that the majority of individuals prefer to get a refund. You know, why make tax season more painful than it has to be, right? Where if, at least you have this carrot at the end of, hey, I get some money back, right? And the argument against that has always been, why would you give the government an interest-free loan? You know, they don't pay you interest on if they're hanging on to $5,000 of yours. Why would you let them hang on to your money for free just to get it back? You know, I'd rather actually owe them so I can hang on to their money. You know, so I've shifted over the years. It's interesting because when I first started doing this work, I agreed with why give the government an interest-free loan. And then as we went through time and banks were only offering you 0.01% interest, okay, where are you getting interest? You know, was always kind of playing devil's advocate a little bit was, okay, I would agree with you if you were able to get some interest somewhere. Now, all of a sudden, we've shifted back to where banks are paying interest again. You know, we're in a higher interest rate environment. So now it's like, okay, well, if I can go get 3 or 4% from the bank, that would be great. The piece you have to be really cautious with this year, which we're anticipating a lot of people are going to kind of get bit by this one this year, is that if you owe too much, you know, what the IRS determines to be too much, which is if you have a balance due of over $1,000, okay, they're going to charge you an underpayment penalty. And that penalty is in the form of they just have an interest rate attributed to that, okay? For the last 10 years, that interest rate has been at something close like 3%. It's been a pretty low number where it's, okay, we can deal with that. That's not too bad. Right now, I haven't looked at it in maybe about a month or so, but it was up to as high as 8%. That's because those interest rates that they have are based on just general interest rate environment. So as we see interest rates go up, the IRS is going to charge you more interest too. So if you're used to every year, you kind of have a large balance due, and maybe you weren't even aware that you had a penalty. You know, it just, the calculation happened. If someone's doing the tax return for you, maybe they didn't tell you. If that's the case, I would reconsider that approach going forward because the IRS interest rate is going to be pretty high for that underpayment penalty. If you are aware of it, of that penalty, and you were someone who said, okay, the penalty was $40, you know, no problem. But now this next year, all of a sudden that penalty jumps up to $200. That's your explanation of why. You might be staring at your tax return like, why is this penalty so high? So, yep.
All right, two more questions. Oh, and a third question just popped up. So I'll start with the third one first. Aren't you required to pay estimated taxes of at least 100% of your prior year's taxes? Is question. We'll just stop with question one.
Yeah, so that's true. So I didn't want to go into that whole calculation, but absolutely correct. So there's another way to avoid a penalty. The other way to avoid the penalty is as long as you've paid at least 100% of last year's taxes in this year. Okay, so what I mean by that is in 2023, as long as you paid at least 100% of whatever the total tax was on your 2022 tax return, even if you had a balance due of $20,000, the IRS is going to say that's fine. Okay, they kind of give you a freebie year on that because they're saying, hey, you might have had an inheritance you didn't expect. You might have had a different windfall of or something. You know, they don't ask what the reason was, but they just say, hey, it's not your fault that, you know, you did your best. You right? You paid 100% of last year's taxes. So, and you made estimated payments or you withheld in good faith that you were in the right amount. Be careful with that too, because the 100% is not that's not where it ends. Depending on how high your income is, if you are in a position where your income is over $150,000 for the household, okay, if your household income is over $150,000, now you have to pay in 110% of the prior year tax. So just be aware of that the 100% doesn't necessarily apply to everybody.
All right.
Yep.
Still three more questions.
Yep.
Another one came in. So these two are next. I'll do these in conjunction. Does your self-employment tax also include Medicare, or do I need to make separate payments into my Medicare account through Social Security? And is self-employment tax the same as estimated tax payments?
So self-employment tax is a combination of Social Security and Medicare tax combined. Okay, so it's a total of 12.6%, I think, for Social Security, and I'm off there slightly, but 2.9% is Medicare and 12 point something is Social Security. So when we talk Social Security, that's covering, or when we talk self-employment tax, that's covering Social Security and Medicare tax. No separate calculations you need to do. As far as your estimated taxes that you're paying, that's actually going to include all of your federal income tax and your Social Security and Medicare tax, self-employment tax, all of that combined. And then your estimated payments should be in line with all of that tax combined.
All right. And then I am new to this tax system. I came here in the month of September 2023, joined on the 1st of October 2023. Should I be paying taxes? If so, in the example on the screen, if all is paid by the church, is it all paid by the church? I also have a car loan that began in January this year. What's the tax I need to pay?
So the answer to that question, one is going to be, I don't know the answer as far as if it is paid by the church. That's going to be more of a question for the church. I don't know if they're withholding anything. And it would depend on what you had communicated to them. So I can probably with much confidence say that they are not If they are withholding anything from your pay, then they're not withholding enough, most likely. And the car, I won't get into that at all. There's not really any taxes on, I mean, the
Sales tax.
sales tax is different. Yeah, so the
Look at your pay stub and see if they're paying.
yeah, for the on the car side of stuff, I think that's more of a there's a whole bunch of other follow-up questions I would have on that in terms of where did you buy the car? The dealership should have handled sales tax and all that kind of stuff. But if it was private party, then when you titled the vehicle, then DMV should handle sales tax on that. But
Thank you.
good.
I'm out of
One-
questions for right now.
Okay.
And he says thank you and everybody says thank you.
Yep. Okay, this is W-2 example for the parsonage. So we've got basically this was the calculations, all the inputs and everything. The 39,000 in the bottom right for federal wages. So we see that in box 1. The same kind of goes for box 12. There's no difference in this case. You're still required to do box 12. So UMPIP contributions are there. HSA contributions are there. Box 14 is a little bit different. So one thing that I will just clarify on here, I put furnishings in there. And almost every tax program will have a limit on how many characters you can use. So we run out of letters to use in box 14. But furnishings, utilities, flex spending, all of those are included there. You'll notice the one thing that's not in there is the fair rental value of the parsonage. Okay, where you might in your mind think, well, why don't we include the fair rental value? Because the church provided the W-2 for you. It's not the treasurer's responsibility to tell you what the fair rental value is of the parsonage. That's up to you. So you're not going to ever get that number on the W-2. What you designate for furnishings will be there, but not the actual fair rental value. Okay, this comes back to an original question we had. Weddings, funerals. So you're going to report this, and this is the question before was, do I get a 1099 from the funeral home for this? And if it's over $600, you would. So $600 is the number where they're required to issue you a 1099. So the thing to remember here is regardless of them giving you a 1099, you're still required to report the income. Okay, so you probably won't get a 1099 for most weddings that you do. You're still required to report that as income. Okay, and I usually just put them on the same Schedule C. It's not like I do one Schedule C for weddings, one for funerals or anything. Just lump it all together. What was your total income? Okay, any expenses that you have which are directly related to this income are going to be deductible. You know, this could be if you're traveling for it. It could be mileage. Okay, so mileage driving to and from a funeral or from a wedding. Could be airfare if maybe you had to travel further for it. Hotels. Anything like that's going to be deductible. The other one too is gifts. So like a wedding gift, you know, I would say that's going to be a deductible expense. One thing that the IRS limits you on though is you can only deduct $25 per gift. And that's not just pastors, that's businesses in general. Okay. So if you think about a realtor who every time they close on a house, they give you a gift or something, they're not allowed to deduct more than $25 per person. Okay. So income after your expenses, so your net income, then that's going to flow to Schedule SE. Schedule SE is that self-employment schedule. Okay. And it's going to get added together with all of your other income that is kind of your self-employment calculation. So that's going back to the previous slide. Okay, calculating self-employment tax, 64,000 on the bottom left. That's us calculating the wages for self-employment. We're going to take 64,000 to Schedule SE, but then we're also going to add in all weddings, funerals, and then maybe you have another source of self-employment income. You know, it's going to be whatever it is. All of it gets lumped onto one Schedule SE. One piece on here, Social Security exemption. I always like to mention this. But I think a lot of this comes back to another question that we had previously too. So Social Security exemption, first of all, what is it? You can claim an exemption from Social Security and Medicare tax if you meet all of the following conditions, okay? So one is you have to be conscientiously opposed to public insurance because your individual religious considerations, or you are opposed because of the principles of your religious denomination. I don't think that's the case in this denomination. You file for other than economic reasons. Okay, so what does that mean? Other than economic reasons is you're not just filing this to save money, right? Plain and simple, that's what it is. And you also have to file a 4361, Form 4361 timely. That is from the first time that you start pastoring, you have 2 years to do this, okay? So, and it's not exactly 2 years, but it's roughly 2 years is like the deadline that you have to actually file this form. I tell you about this because ultimately it's something that you can do, but I also more importantly share it with you to caution you on this because I've known plenty of individuals who have received advice to do this. You can't revoke that decision later, okay? And what does this do? If you are opting out of Social Security and Medicare tax, you are not going to be eligible for Social Security benefits down the road. You're not paying into the system, okay? So if this is the case, you really better have a good retirement plan otherwise, you know? So yeah.
So would this, speaking of dangers, if you did this and you became permanently disabled, would you be excluded from receiving disability benefits from Social Security as well?
Yeah, Social Security, as a reminder too, is not just retirement benefits. It is retirement benefits. It is benefits for disability. It is benefits in the event of for a widow who has minor children. You know, all these different scenarios, and no, you're not going to be eligible for any of it if you're opting out of this. So it's just be extremely cautious with it. Don't do it just because somebody told you to do it. Make sure you're getting really good advice and your reasoning for it before you actually go ahead with this. So
Right.
mostly just like to touch on it.
Then James, if a church pays for a pastor's cell phone, is that included with the utility total on the W-2?
Yes. So, or you could include it separately, or it doesn't, you can kind of include it. It needs to be included as compensation, just like anything else. I think that would probably be the best place to put it, would be in the utilities. Yeah, maybe people have been putting it there and I did not know it. You know, I get a number from individuals, right? And I don't always necessarily know what all is in that number. I kind of assume utilities is utilities, but no, if the church is paying for your cell phone, I think that's a good spot where it could go.
All right, a couple more. And I think this is what you were just saying, is can pastor's cell phone be on housing allowance? And I think you just said yes to that. And then someone else said also, if you opt out of Social Security and Medicare, most health insurance will not pay what Medicare would, so you could be left with very large medical bills after the age of 65. And I'm sitting here watching Gene's head, our conference benefits officer's head, go up and down like one of the birds dipping its head into the glass of water. So don't, yeah, really, in our denomination, does not support this. So it'd have to be a personal thing.
Yep. Okay. So I've got, I'm kind of done with a lot of the clergy related things. But I know we are maybe 15 minutes left or so. So what do you prefer, Jason? I guess, do we have any other questions from anything we've kind of gone through? I can skip the rest of this and keep fielding questions related to pastors. Otherwise, I can keep going through this and then go back to pastor questions once they come in.
Okay.
Or it's kind of...
So the next portion is for retirement, correct?
Not necessarily retirement. This one I like to include just for pastors to be aware of and for church members in general to be aware of, but I have a whole different slide deck.
Yeah, why don't we go ahead and hear, because I think we're getting the questions as they're coming up in people's minds.
So this one, qualified charitable distribution, is not anything that's special towards pastors or anything, okay? This is just a benefit that is out there for any individuals who have turned age 70 and a half. I more often than not include this because I want you to be aware of maybe why certain individuals are donating to the church through their IRA. And also understand, hey, if you know anybody who's donating to the church and they're over 70 and a half and they're not donating through their IRA, why they maybe should be. You know, this isn't a blanket, everybody should be doing this, but it's pretty rare to see a situation where it wouldn't be beneficial. Okay, so what is a qualified charitable distribution? Which we'll call a QCD from here on out. A QCD is a direct transfer of funds from your IRA custodian payable to a qualified charity or church, and it is counted towards satisfying your required minimum distribution. It is not included in your taxable income on your tax return if certain rules are met. Okay, so these rules, what are the requirements? You have to be at least 70 and a half. You have to make the transfer directly to a qualified charity. So also this doesn't need to be a donation made to the church. It can be any charity. Okay, this could go to the Dane County Humane Society. Maximum amount is 100,000. Okay, and to qualify towards the current year's required minimum distribution, the funds must come out of your IRA by December 31st. So for anybody who doesn't know what a required minimum distribution is that, and they've changed the ages around a little bit so they don't line up anymore, but a required minimum distribution is required at age 73 right now. So at age 73, you are required to start taking money out of your retirement accounts. Okay. The reasoning for that is the IRS is saying, hey, you put money into this and you've never paid tax on it. Okay, I think if you made a contribution into UMPIP, okay, you got a tax deduction when you put money in, and you've never paid tax on that your entire career now. And the IRS is saying, time for us to collect some taxes on it. Okay, so going through a breakdown just to show you the calculations of how kind of beneficial this can be. So let's just say that someone is donating $6,000 through a QCD rather than writing a check. Okay, so what we see is that it not only reduces their income, it also is going to impact how much of their Social Security is taxable and going to make a pretty significant deduction. I have two different tax returns I'll show you, but basically, long and short of it, I'll give you a spoiler alert, but in this case, $2,495 of tax was saved just by having $6,000 go directly from an IRA instead of taking the money out of the IRA into your bank account and then writing a $6,000 check to the church. Okay, so pretty significant savings here. So here is just kind of a zoomed in picture of the tax return. What I really want to look at is line 4B. Okay, this is the assumption of IRA distributions for the year, 55,000. And Social Security benefits, you'll see right in the middle, I don't know, because that probably doesn't even show up. Right in the middle of the screen, 5A, you see 58,000 is the total Social Security benefits that this individual has. The taxable amount over to the right is 48,500. Okay, so just kind of remember those numbers a little bit. We'll see at the very bottom down here, we've got $9,958. That's the total tax. Okay, so in this scenario, what we've seen is now the top section, the IRA distributions was still 55,000, but only 49,000 was taxable because 6,000 went directly to the charity, church, any other charity you want. You'll also see the second one down, Social Security benefits. You look at 5B, only 43,000 is taxable now, 43,400. So Social Security benefits in retirement are a little bit of a difficult calculation, but essentially the rationale behind how Social Security benefits are taxed is that if Social Security is your only source of income, you don't pay tax on Social Security. As you have other sources of income, whether that's IRA distributions, whether that's pension income, whether it's self-employment income at that point, still, it doesn't matter. Basically, they're saying, hey, you can afford to pay some tax on Social Security. Okay, right, wrong, and different. It's kind of a means-based system. Okay, saying the more you make outside of Social Security, the more tax you pay on Social Security. But in this scenario, because we kind of have a domino effect of not only did we get 6,000 off of our tax return there, we also got in another basically 5,000 off of the Social Security. Our total tax down at the bottom here is 7,400. Okay, 7,463. Nothing changed with how much you gave that year, okay, you still gave $6,000. Okay, nothing changed. There was no additional money out of your pocket. You just saved $2,500 in tax instead. Okay. I don't need to do step up in basis. I don't think so. Social Security earnings record. I like to mention this too. It's important to keep an eye on your Social Security record. Okay, so it used to be that Social Security would actually mail you your earnings record every single year, and you've probably noticed that you don't get those anymore. You probably didn't really think too much of it, but you're like, oh yeah, I haven't received anything from Social Security in a long time. So in 2008, I believe it was, it might have been 2010, they had a Paperwork Reduction Act, which they put into place. Essentially, it was them saying, hey, we don't need to send billions of copies of Social Security paperwork out that no one looks at. So essentially, they will give you a Social Security statement once you turn 55, and then every 5 years after that, essentially, as you get closer to retirement. Anyways, you can always look up your Social Security earnings record online. If you go to ssa.gov, you can create an account there. I encourage everyone to go make an account there, and then every year, make sure that your numbers are correct in there, especially for pastors. You want to verify that what you reported on the tax return is then getting reported to Social Security. I get a couple questions every year, usually in like February, of, hey, my Social Security record doesn't appear to be correct. You have to give it some time for it to update, because first your tax return is filed with the IRS. The IRS then gives that information to Social Security. So basically let it go until May or June or so, something like that. If it isn't updated by then, now we got to call Social Security, and you have 2 years to report any errors in reporting, and they'll correct it for you. Sorry, I have that right here. Correct up to 3 years, 3 months, and 15 days. So more than 2 years. So, but if I tell you 2 years, then you're way ahead of the game there. So 3 years, 3 months, 15 days to correct the wages that were reported. And sometimes what you might find out is you say, hey, this is incorrect. And Social Security says, well, this is what the IRS said. And then you go back and you realize that you did your tax return incorrectly, for better or worse. Right? So, all right. Just in the back of this, I just have some definitions for parsonage and for homeowners, this type of stuff. So that is all that I have for this section. So what questions we got?
I want to pay my tax every quarter. What form do I need to fill?
Yeah, if you are wanting to pay your estimated taxes each quarter, so you're paying estimated payments and quarterly payments are the same thing, just so everybody knows that. There is going to be a form called a 1ES. I'm actually going to look this up real quick. I believe it is an if you go to the IRS website, they're going to have the forms that you need there if you just were to search for estimated tax. But the form itself is going to be a 1040 ES for estimate. Yeah, 1040 ES. That's what the name of the form is. And then on the top right-hand corner of the form, it'll have a 1, 2, 3, and 4 for which quarter you're paying it in. Okay, first quarter, second quarter. And then the state has one as well. Yep. So then the states would be, I'll look that one up. So the Wisconsin one is Form 1ES. And then that won't be the same thing. Just put in the amount that you're going to pay, and you pay those in on a quarterly basis. The state, you can make the payment online. You can make it online for the IRS as well. So Personally, if you are able to do it online, I always encourage you to, just because you know it happened then and you can print out a confirmation. I'm not too concerned about Wisconsin, but the more and more that we work with the IRS especially ever since the pandemic, the IRS was behind before the pandemic. Then the pandemic happened and they are so far behind now. It is not uncommon that we send a check to the IRS and maybe it gets deposited, but then it just doesn't get applied correctly in their system. Okay, you can prove that you made that payment later. Just keep a copy of your check. There's no problem there. It's just a little bit of a hassle. If the IRS says, hey, we didn't receive your payment, and you say, well, you cashed my check. It's just a little bit of a hassle to go back and, send them a copy of the canceled check and, bank statement or whatever it might be. So if you make it online, it's a little bit cleaner, kind of takes the human error element out of it. So
I have
You're up.
questions. I was worried it
What do we
wasn't
got?
working. Question regarding QCD. What type of reporting should the church do for a donation from QCD? Do we list it as non-taxable?
So the church does not do anything with, if the church receives a QCD, qualified charitable distribution, it's no different on their end. There's no different classification or anything. You should be sending that letter at the end of the year acknowledging the receipt of it. Typically you're going to give your thank you note along with acknowledgement of no goods and services were received for this. So that should be given to the donor. But aside from that, in order for this to be correctly handled on the tax return, all that the taxpayer does is they just subtract the number off of their taxable amount, and it's very straightforward. The important thing to know too is that as a taxpayer, when you make a QCD, the 1099 that you get from your IRA custodian is not going to say you made a QCD. There's no designation. They're going to say, hey, you took a distribution and it was taxable. That's what the form will say. So you have to override that on the tax return. And all you do by overriding it is simply write QCD right next to that form. If you're doing this online, there's going to be a box somewhere to check of saying, hey, I did a QCD, and they'll code it appropriately. But that's the biggest thing to be aware of, is even if you are working with a CPA or an accountant of any sort, if you make a QCD, you have to tell them. They have no idea you did it unless you tell them.
So one follow-up on this, and I run into this with financial secretaries a lot, and I'm guessing Gene does too, is they get very concerned that a lot of the church software programs have a box that says this is not tax deductible. Please tell me if I'm wrong. Ultimately, it is up to it's the taxpayer's responsibility to say whether a donation is tax deductible or not the church, correct? For monetary donations?
Yeah, that would be correct. I would imagine, I've never seen the software you're talking about, but I would kind of imagine that software is, if you're checking it's not tax deductible, that would be the equivalent of you saying, we gave them something in exchange for this. It has nothing to do with the tax deductibility anywhere else. I would imagine that's more the church just taking initiative and saying,
You bought a book.
hey, you bought something. Yeah, exactly. So I would imagine for their use, that's what it would be for.
Okay.
And this is along those exact same lines. Do we assume if the check stub says IRA distribution, do we assume non-taxable? Church side.
Yes, I'm trying to think of other questions behind that question is all. But yes, it would be non-taxable.
But in the end,
Yeah.
it doesn't matter church-wise, it matters individual-wise, not from the
Right,
church.
right.
But as Jason was saying, some of our churches, their software isn't church-based, so it has other items that it would matter, things could matter non-church related. And so we're using items that are not always geared toward a church. So
Right.
things like whether or not people's money is taxable or non-taxable when the church gets them, like QuickBooks, it doesn't matter. Yay to them. But I will actually go one step further. If you find this out, I wouldn't then go and say, hey, I know you did your IRA, but it would be a good thing if they're willing to tell you that, preferably from their end, not your end. If you could get them to do that as a testimonial to then get more people to give via like their IRA, that's actually quite helpful.
Yeah, that's a piece. That's almost why I bring this up is I haven't really thought of a specific way of bringing it up. I just want to give you the information of this is available out here, because if you think about it from a donor's perspective, they gave $6,000 either way. You know, in many cases, if they were giving $6,000, that's $6,000 they did not need. You know, they were wanting to give that to the church. If they save $2,500 in taxes, do you think it's possible they might give $7,000? You know, it's basically, hey, if we can give extra to the church instead of giving extra to the government, that's kind of the mindset. So that's the biggest reason why I actually bring this up, is if there's any way of like just creating this education for individuals who are over 70 and a half, just to be more efficient with donations. I will say too, the reason why this is so important with QCDs is that a couple years ago, they increased the standard deduction to a point where no one really itemizes their deductions anymore. So the standard deduction, if you're 70 and a half, is over $30,000 this year. So you would have to, in order to itemize your deductions, you would have to have mortgage interest, real estate taxes, and charitable donations total up over $30,000. And there's a few other things in there too, but usually you don't have a mortgage at that age, or it's getting down there where you don't have a ton of interest that you're paying. So it's very, very difficult at that point in your life to actually itemize your deductions. You don't double dip, so you can't do a QCD and deduct it as an itemized deduction. Okay, so you can only do one or the other. But yeah, in most cases though, it's going to be, hey, in this scenario, this is off the first page of the tax return. Okay, line 4 here is we took the deduction there rather than having to try and take it off of the standard deduction, which is right here. So this is last year's numbers, or I don't know, numbers from, they might be 2 years ago numbers, but everything else is basically the same, just numbers for inflation have changed. So,
And James, one shameless plug for the Wisconsin United Methodist Foundation. Crystal and I go around and do planned giving seminars, and we highlight this for all of those who are in attendance, and spend lots of times chatting with folks to be clear that they understand this. So we're happy to come to your church and talk.
there you go.
So I think we're ready for retirees. So lots of thank yous. And
Great.
the next section for everybody online is a section on clergy in retirement, which some of us are closer to than others. Woohoo! Speaking to my father, who's been retired for 2 years, he thinks it's the best thing since sliced bread. Oh, one last question, James.
Yep.
If a church designated housing allowance is $30,000, but mortgage is $24,000, could I pay the extra $6,000 in principal and claim the full $30,000 as housing allowance?
Say that one more time.
Okay. The church designated housing allowance is $30,000, but mortgage is $24,000. Could I pay the extra $6,000 in principal and claim the full $30,000 as housing allowance?
Yes, you could. We need to look at the fair rental value as well and make sure that that's, if the fair rental value is only 20, then we have an issue there. However, if you're saying the mortgage is 24, the first thing that I'm going to say is the mortgage all you're counting? What about utilities? What about furnishings? What about you know, all of these other deductions throughout the year that you could be adding in, you're very likely already over 30,000 if 24 is just plain and simple the mortgage.
One thing I will say too, and pastors get this confused, just because in the church budget, one says salary, one says housing allowance, that doesn't matter tax-wise.
Yep.
It's what you decide to claim. So you can actually claim more for a housing allowance than the church has in their budget by using some of your salary to supplement that. So if the church says it's 24,000, but with all the calculations that James has gone through, you actually pay 30, that's actually deductible, then fill out the form that says I'm withholding 30 as a housing allowance on the form at church conference and do that with your taxes. Is that correct?
Yes, that's correct. So the biggest thing that I like to emphasize over and over and over again is if you don't know what to designate your housing at and you don't want to shortchange yourself, make it the same as your fair rental value. Okay, if you don't know the fair rental value, then I usually say whatever you think you're going to do for a housing allowance, pick that number and add $10,000. You know, I kind of say, and the point in that is over designate. There's no penalty for over designating. And at the end of the day, we're still going to come back to the lower of the three, not getting penalized. So let's just not make sure we don't leave a benefit on the table.
Talk about what you do if you don't spend it all.
Yeah, and so if you don't spend it all, that's another calculation that you just have to handle on the tax return of let's say you designated 30,000. So 30,000 is how much you designated. And the amount you spent was 26,000. And we'll just say the fair rental value was 30 as well. Okay, so the limiting factor is how much you spent, which was 26,000. So the W-2 is not going to reflect what you spent, right? The W-2 is going to reflect how much was designated, right? And so on the tax return itself, right where you report wages, there's a code that you put in there to say unspent housing, and you add that back into your wages. So in that case, you'd be adding back $4,000 of income. Because what are you doing on your W-2? You're subtracting 30,000 off of your gross wage from the W-2, and then you're just going to add 4,000 back on the actual tax return just to true that up to what it should be. So, yep.
I got a couple of questions. In the past several years, I've been doing my non-church related tax with the CPA. My first question is, if I donate 30,000 to a church, what is the maximum of the tax deduction from the IRS?
So I can answer that question in two ways. So one of them, my first question would be, did you do it directly from your IRA as a QCD?
No, not from my QCD.
Okay. Then the second one is going to be, there isn't a dollar amount that is the limitation. It's a percentage of income, actually. So you can't give more than 50% of your income. Okay. If you do, you carry that number over to the next year. So you don't lose the deduction. It's just going to carry over to the future year. And if you're working with a CPA, they would be tracking that for you of say your income for the year was $40,000 and you gave 30,000. You can only deduct 20 in that year, half of your total income, half of the 40. The other 10,000, you're going to carry over to next year's tax return and be able to deduct it in the following year.
Yeah, my CPA told me, if you give 30,000 to a church, the IRS only give you 5,000 tax reduction.
Yeah, so it should, I mean, it should be carrying over to the next year. I'm trying to think if there's anything else. Oftentimes the answer to questions like that are very difficult because there could be 3 other things on your tax return, which I don't know about right now too, which could be other limiting factors. Yeah.
I didn't have church salary, but I do work with a home care firm. So I have some income
Yep.
From that, being a nurse practitioner and side paper
Yeah.
and see a patient. And I also have my pension.
So the other thing, and this is all, I can speculate on things as well. And I would also say it's possible that what he's telling you is you are only deducting $5,000 because he's looking at the comparison of what your itemized deductions are versus your standard deduction. So it's possible that even though you gave $30,000, that you only received a benefit for $5,000 because you would have taken the standard deduction anyways. So it's possible that he's just basically saying, hey, your real benefit here was being able to deduct $5,000.
Okay. My second question is, this year, since I've been with the church, so I can do a lot of tax related with the church.
Yep.
So does your firm provide any person who can help pastor doing the tax?
We'll talk about it afterwards.
Okay.
Yep. Are we good
We're
to go?
I think
All
we're
right.
good to go.
Retirees. So a lot of this is really similar format as what we had before too, but all right, we'll jump right into it. So once you're retired, forget the SE tax, the self-employment tax, for the most part, right? So according to the IRS, I just like going through, okay, when we think about self-employment tax, we have to think about what do you have to pay self-employment tax on? So per the IRS, examples of earned income are wages, salaries, tips, other taxable compensation, taxable employee compensation. Earned income also includes net earnings from self-employment, okay? Compensation for performed services such as weddings, funerals, pulpit supply. That's what's going to kind of apply to you guys. Earned income does not include amounts such as pensions, annuities, welfare benefits, unemployment compensation, workman's comp benefits, or Social Security. So when I say forget the SE tax, saying, hey, if we're fully retired, and you're no longer working, you don't have to pay SE tax on Social Security benefits or pensions or anything like that. It's only on earned income that you have, okay? So we just jump right into a tax return calculation here. So this is calculating income for income tax for estimated payments. So kind of helping you go, once you get to retirement, there's not really anyone there to withhold taxes from your paycheck. So you're looking at, okay, how do I calculate an estimated payment and pay those in quarterly? Okay, so in this scenario, we're looking at sources of income being pension income, Social Security income, IRA distributions. And I'm kind of giving you an extreme example here too, which an extreme example, but not uncommon. In this scenario, we have IRA distributions. We've got $10,000. The line 5, I've got pensions and annuities of 30,000, but the taxable amount is only 10,000. Okay, so my assumption behind the scenes there, which I haven't even talked about yet, is that that's where we're deducting a housing allowance. You still get a housing allowance in retirement. Okay, so the difference between the 30 and the 10,000 is 20,000 of a housing allowance. Social Security benefits, I've got an assumption of $35,000 in Social Security benefits. You're only paying tax on $2,750 of that. Okay, going back to what I said before too, is the way that your Social Security is taxed is kind of means based. Okay, so they're looking at, hey, how much other income do you have? Which in this case, they're not looking at the total you took out of your pension. They're looking at the net amount. So after the housing benefit, the housing benefit for pastors can really create a really, really large domino effect for you where it's just lowering your income. So total income, okay, on like line 11, see is 22,750. The standard deduction, which this year is 30,000, but in this example, we've got 27,000. That wipes out all of your income. Okay, so your taxable income here is 0. There's no tax in this scenario. Okay, so here we have a retired pastor who, how much money did they actually receive throughout the year from various sources? 10,000 from an IRA, 30,000 from the pension. Now we're at 40 total. plus 35,000 of Social Security benefits, they receive $75,000 in benefits and their tax is 0. Okay. So kind of just gives you an idea of this might be your case. Okay. So for calculating estimated payments, how much do we have to pay in each quarter? Nothing. Yep. So that's scenario 1. So scenario 2, just kind of bump numbers up a little bit here. Okay. So same scenario. All that we're looking at is we took an extra $10,000 out of the IRA. Okay. So what did we do that for? Okay. Maybe just expensive living is higher for these individuals. So they took an extra $10,000 out. Maybe these individuals said, hey, I want to put an extra $10,000 towards, the mortgage or towards something, which really doesn't give them a huge benefit in this scenario. Either way, we've got 20,000 of IRA. I left the housing the same in the middle. So 30,000 total distribution, only 10,000 is taxable. You see, since you took another 10,000 out of your IRA, now you're paying tax on 8,900 for Social Security. Okay, it's this domino effect of as you take more out of your IRAs, you're paying more tax on Social Security. So that bumps our total income up to 38,000. After the standard deduction, got taxable income of 11,000 all the way at the bottom. That's line 15. So in this case, your total federal taxable or federal income tax would be about $1,100. So if you were wanting to make estimated payments in this case, what would you make for estimated payments? $300 a quarter. That gets you to $1,200 for the year. You get a refund of about $90. Or we had the conversation before, all you do is owe $1,000. You're over that limit of what the IRS says, hey, they're going to start penalizing you. But you could say, okay, I'm okay with that. They're going to penalize me $20 for not paying in, but $20, I save 4 stamps, So it's just, that's, there you go, so depends on how much $20 is worth to you, right? So, next example, okay, so I'm just kind of pushing it more and more. What about in this case, the IRA distribution is 50,000, okay? So they take a 50,000, housing is still the same in the middle there. Social Security benefits, you all of a sudden see, now you got to pay tax on 29,000, okay? This is actually the maximum that you would be paying tax on for Social Security. So Social Security caps out at 85% of your benefit being taxable. Okay, so it's not 85% tax. It's if your Social Security benefits were $10,000, the most you'd ever have to pay tax on is $8,500, 85% of your benefit. And so just bumps all their income up because of that IRA distribution. So taxable income down at the bottom on line 15 is about 62,000, and your federal income tax I've got over on the left-hand side would be about $7,000. So in this case, this would be more of a spot where I'd say, okay, let's have you make estimated payments of $2,000 or so, somewhere in that range. Yep, Gene.
Is there a chart or something? Because if you're trying to figure out estimated, how do you know based on all of this? This is your Form 1040. If you're trying to figure out estimated payments beforehand, how do you know how much of all of that of the Social Security is going to be taxable based on?
Yeah. So the answer I can give to you that is on the IRS's website, they have an estimating tool where you can plug in all your variables.
All right.
The first time I saw it, which it came out brand new like 3 years ago, it was wrong. Like it's just, it was bad. I do think they've improved it, but we don't use the IRS's site for that, but you can kind of check that out and see if they have a tool available. Otherwise, you would prepare a tax return, based off of prior year tax form. So essentially, hey, you get to prepare a tax return just as an estimate to see how it goes off. If you're working with a tax professional, talk to them and they'll do these calculations for you. The trickiest thing in all of this is that when coming up with estimated payments, it's really, really important to be accurate with your estimates of your income, because especially in these two scenarios, you see, we go from $1,000 in tax up to $7,000 in tax. It's like, just because of the domino effect with Social Security, you're going to see really wide swings pretty quick, which you can look at that as a positive or a negative. The positive is, if we plan accordingly, we can get the domino effect to go in your direction, right? When you just take an extra $10,000 out of your IRA because you need money, but you didn't necessarily need it this year. Maybe you took it out in December, but you could have waited till January. It's like, those are the types of conversations where it's nice to have it with someone who's doing your tax return, of saying, hey, what are the impacts of taking this out this year versus next year? What do you kind of recommend? So I don't have, and the biggest reason why we don't, I'd love to have like a little bit of a chart to say, hey, if this is your income, great. But there's so many different variables in here, where when we talk IRA distributions, we might be talking Roth IRAs there too, which are going to be totally different. If we're talking, the housing allowance is definitely going to come into play here. Social Security is going to come into play. If you have interest and dividends throw a whole another wrench into this, because you can know pretty well what your dividends are going to be throughout a year if you have an investment account, but you don't know what there's going to be from other capital gains and everything. There's certain things that happen inside of an investment account that you can't plan for, because they just happen automatically in December, and there's nothing you can do to stop it. That's just the way some of those investment accounts work. So that's why we've never had like just a simple chart, because it's too many variables. And then as soon as you say, hey, mine's really simple, then you inherit $20,000 and your situation just got not simple.
Well, and the other thing, while I have the microphone, that I wanted to remind people of is that when you're calculating your housing allowance exclusion, you can only use pension money that comes to you from Westpath to claim that housing allowance exclusion.
Right.
Now, for a lot of us, that's the vast majority of our income, but with more and more second career people, you can't take money from any other retirement vehicle and claim that. And a lot of times people are like, well, my financial advisor wants me to move such and such money from UMPIP over to their agency. That's fine. I don't care what you do. Just be aware that if you move too much out, you might not have enough to cover your housing allowance exclusion.
Right. So really, really important to know there that your housing allowance in retirement, we have the same 3 tests. We'll go over those again and everything, but you have to remember that this only applies to money that you saved while you were a pastor. Okay. Now, there's plenty of planning to be done around that. I have plenty of second career pastors who have accumulated a $300,000 account in their previous job. And what am I doing now is the first thing I say is, how do you feel about maxing out your UMPIP account and putting $30,000 a year into that? And they're like, great, where am I going to get that money from? Well, all that we do is we just set up distributions out of your previous retirement account to kind of supplement your income, because your entire paycheck is going to be going into the UMPIP account. So there's plenty of, and that would be like if you have 5 years, say you're a second career pastor and you are going to be a pastor for 5 or 10 years, something like that. We have kind of a runway of, what am I trying to do? I'm trying to essentially convert this old retirement account into a UMPIP account, because that's going to be eligible for housing.
And correct me if I'm wrong, James. And if it's all retired clergy, it might not matter anymore. But this is why when I've worked with you in terms of taxes and financial planning, you've talked to me about carefully considering what I put in other retirement vehicles, because I should maximize the UMPIP for the housing allowance benefit first before I do other things, unless I have other goals. Does that sound about right?
Yeah, absolutely. So I always encourage, UMPIP is the best possible place that you can save. The real benefit of it too is, if you were watching the last presentation along with this, we didn't get into the details of it, but if you noticed, when you make a contribution to UMPIP, it reduces your tax for both federal income taxes and for Social Security and Medicare tax. I'm a regular employee. Okay, so when I contribute to my 401k, I do not get a deduction for Social Security and Medicare tax. No employees do. That's not a deduction that you get. This is the only place in our tax code where an employee gets a deduction for Social Security and Medicare tax based on retirement contributions. So when I use that scenario of say I'm moving $10,000 a year from an old IRA and essentially using that to fund the UMPIP account, what you really have to think is, okay, I'm taking 10 out of an IRA. I have to report that as income. It's taxable income. But I'm getting a deduction when it goes into UMPIP for the same federal income tax, but I'm also getting self-employment tax as a deduction. So what am I really doing? I'm getting a 15% deduction because the federal income tax cancels out between the two. I'm getting a 15% tax deduction, and I'm converting this into a tax-free account once I retire, as long as it's used for housing. Okay, I'm making it eligible to be tax-free. So when we think about retirement plans in general, I think the whole industry oftentimes, from a tax standpoint, it's a little bit misleading the way that we talk about retirement accounts, because we say, oh, you get a tax deduction. I don't like calling it a tax deduction, even though it is. What you're really getting is a tax deferral, right? You're deferring that tax and you're saying, I want the tax break now and I will pay the tax on it later. The exception to that is if you're a pastor and you have this account and then you use that account for housing in retirement, it's still tax-free. So it's a true tax break for you guys. So just lots of different planning opportunities there. But housing allowance in retirement. So you still get a housing. Kind of going to reiterate some stuff here, but when we think about those three tests, your entire pension UMPIP account is going to be designated as housing, okay, which can be exempt from federal income taxes if it's spent. Okay, so you guys don't have to worry about the designation aspect of it. The whole thing is designated by the conference. This is going to include purchasing a home plus furnishing the home. Same rules as before. So these are the examples. So this is mostly going through this. We had this one in the last slide too, but it's good just to reiterate it. And then if there's anyone who hopped on for this section only. So examples included in the housing allowance. It's going to be down payment on a house, mortgage payments, both interest and principal, homeowners association dues, real estate taxes, homeowners insurance, utilities, furnishings, appliances, basically everything. Does not include cleaning services or personal items. It doesn't include your toothpaste, right? So I didn't give this example last time, but the example that I like to think of in determining what is eligible is if you think about going to a vacation home, you're going to go to the Wisconsin Dells for the weekend and you're going to rent a cabin. You're going to Airbnb and you're getting your cabin. What do you expect to be provided for you? If you expect it to be provided for you, that counts because that's what's included in the housing allowances. It's the value of a fully furnished home. Okay. So in an Airbnb, you expect it to look nice, so that we're talking about lawn care. Okay. So if you need to buy a mower, the gas you put in the mower, all of the maintenance type stuff around the home, it's all important. You expect them to have some form of entertainment. Netflix, times have changed, right? You used to show up and there was like 50 VHS tapes, right? And that's what you would do for entertainment at a rental like that. Now it's okay. They have a smart TV. They've got Netflix and, Amazon Prime or whatever on there. So all of those I count towards housing, Amazon Prime accounts, I count towards housing because that's where you're purchasing a lot of your home goods and your form of entertainment. You're watching movies through Prime. Okay. Usually we don't have to get to that extent of trying to like squeak out but there are a few instances where it's like, okay, we need cell phones, we need Netflix, we need like every little dollar we're trying to scrape up. So whatever you expect to be included in one of those scenarios, that's what you're going to be able to include in your housing allowance. So the other thing too, we see this more in retirement, is going to be that there's different types of housing that qualify. Okay, this could be a purchased home, it could be a rented home, could be a travel trailer, could be a boat. Here you go. You know, so here's the catch. You're all getting real excited there. So requirements is it has to be your primary residence. Okay, and you can't have two primary residences. Okay, you could, if you had two retired pastors who each had their own retirement accounts, and you truly had two different established residences. That's going to be tricky when it's like, okay, where is mail going? Where are you registered to vote? Where are driver's license? Like all of these types of things, you would have to have an order. So might be where. No, you could file joint. Yep. There you go. No, you can't do that. No, can't do that. It's just if you're parking it in your driveway, then your house, you probably spend more on your house than your travel trailer. So, but and also it has to include a bathroom. So this is like true of when anytime the IRS is saying, hey, what qualifies as a primary residence, it has to include a bathroom. So if we're talking the houseboat, we just got to make sure that we've got a bathroom on that yacht you buy. That's right. All right, same exact thing as the last one too. So you're, in general here, you're not able to just cash out your entire UMPIP account tax-free in a single year. There's limitations in place, just like when you were working. Okay, so you can't say, hey, I'm going to move. I want to take $250,000 out of my UMPIP account and buy a home where I'm moving. You're not able to do that because the fair rental value is not $250,000. That's the limiter. So the amount designated, that's fine. The amount spent, if you actually spent $250,000, that's fine. But the fair rental value is not going to be $250,000.
James, I'm assuming this isn't just UMPIP, but also the pension portion as well?
Yes. Yep.
Okay.
So the pension portion, UMPIP, I just kind of all say it that it's like one piece basically, but all of your retirement, it all qualifies for that. So thank you. So yeah, same thing. Housing allowance is the lesser of the three. So there's no amount. So the amount designated to on that same question, like your entire pension is designated by the church. UMPIP is also designated, like everything there is designated. Okay. Okay, fair rental value, same thing again. So get a letter from a real estate agent if you're really. The only times that I really force someone to go get a letter from a real estate agent is like when we're pushing it, right? In most cases, it's not that difficult. Like you can find something comparable on Zillow and, you just find comparable houses, print them off, keep them in a file, and you're going to be set. I've never seen it questioned, but I don't want to be empty-handed when it is questioned, okay? More often than not, if they find that they're going to disallow something for you in 1 year, they don't just leave it at that. They're going to now open up the 3 years prior to and say, hey, looks like you did the same thing. Right? So, okay, so let's do some examples. So Pastor Ann has now retired, so owns her home, receives a pension of $30,000, which is fully designated as housing. She spent $21,000 on mortgage payments, taxes, utilities, furnishings. The fair rental value of the home is determined to be $24,000. So she can exclude $21,000 from her income tax as that's the lowest of the three. Okay, so what she spent was $21,000. And I can go back, in this case, okay, I'd evaluate in this scenario and I would say maybe she should have spent more. At the end of the year, if you're trying to get rid of your mortgage, there's still some money on the table. Like I don't want you paying off your mortgage if you're going above and beyond the housing allowance, but what she spent was $21,000. So at the end of the year, if you run these numbers kind of November, December, you're going to have a good idea at the end of the year where I'd actually say, you know what, if your mortgage interest, if you got your mortgage anytime in the last 2 years and your mortgage is sitting at a 7% rate, yeah, I want you to take $3,000 here, the difference between the 21 and then the next lowest, which is the fair rental value. And I want you to go pay off, a chunk of that mortgage. So now ultimately that's going to be a personal decision of, just what you think on your investments more, that's just up to you. So, yep.
All right, took a second. So, say I'm retiring. I'm
Yep.
not, I've got, at least a year or two before that. Kidding. And I have a balance on my mortgage that I'm able to pay off, but say I have an interest rate that before the interest rates went up, that's about 2.5. Would you then recommend to the person to consider not paying off the mortgage for the tax savings that's going to come?
Yeah, in that scenario, I mean, ultimately, all that I'm going to be able to give you advice on is telling you, hey, this is, say you were to maximize your housing benefit. Okay, this is how much you would save from a tax perspective. Say you don't maximize your housing benefit, this is how much you're paying in mortgage interest. I can run those scenarios, and then I just leave the choice up to you.
Okay,
But that's the comparison you're looking at, is you always want to look at how much interest are you paying and how much tax are you saving based on maximizing that housing benefit. Typically, I'm not super eager to have individuals paying off their mortgage in retirement. You're the only occupation I'd ever say that to. But the tax benefit is so great to be able to deduct the principal and interest of the mortgage and especially if you're in a case where you're only paying 2.5% on your mortgage, leave all of this aside anyways, most people would probably tell you not to pay that off.
Okay, so
Right.
really make sure you're talking to a person
Yeah.
who specializes in
Yeah.
clergy taxes
Yep.
and have them put those scenarios before you.
Yeah. Yep. So, yep.
Hold on.
So by looking at all of these, when we're talking about housing allowances, pastors who don't have a mortgage really don't get much of a housing allowance. Is that what you're saying?
If it depends, but in general, yes. It just depends. I have plenty of individuals who I work with who somehow come up with housing expenses, and there's a big part of me that's kind of like, you're just spending money to spend money, and it could be, okay, they bought a new set of furniture that it's like, didn't you buy a new set of furniture last year? Like, what are we doing? Like, so I think it forces you into the mindset of, hey, I got to try and spend. So they're always looking for reasons to spend that they probably wouldn't otherwise. But in general, yeah, I mean, what are you going to have? If you don't have a mortgage payment, depending on where you live, obviously, is going to be the real driving factor of it. But if you're in Dane County, you're probably pretty easily going to have $15,000 regardless, because your real estate taxes in Dane County are going to be $5,000 to $8,000 right off the bat. Then put utilities on top of that. Okay, we're at another $5,000 there. So start putting in, okay, all the other stuff and Netflix. That's where I start scraping up some stuff with like Netflix, but you're still, when you think about, okay, you gotta, bath towels, kitchenware stuff, okay, new pots and pans, like all that stuff still counts as housing. So you're just more diligent in keeping your receipts at that point. If you have a mortgage, it's pretty easy because you're like, great, mortgage, real estate taxes, homeowners insurance, utilities, I'm already at $30,000.
Okay.
We can talk more at the end too, if you have some questions. Yes. Okay, weddings, funerals, same exact thing as when you are working. So reported as self-employment income on a Schedule C. Expenses that are directly related to the income are deductible, and all of this is going to go to the Schedule SE. So you are required to file a Schedule SE and pay self-employment tax if you continue to do this in retirement. So on this, it doesn't matter whether it's this or maybe you have a quarter-time appointment, depending on what it might be. One thing to keep in mind is that if you retire, say at age 62, which is the earliest you can retire for Social Security purposes, that is early retirement in Social Security's eyes. And they say, if you retire early, you're limited as far as how much you can earn. Okay. if you earn over a certain amount, they're going to penalize you. And they're going to say, hey, you earned over a certain amount. Now you got to start paying us your Social Security benefits back. Okay. That amount is roughly 20,000. It's adjusted for inflation each year. I think it's like 21,000 something this year. But it's just to be aware of, if you're 62, just because you're retiring, I'd be a little cautious on drawing Social Security. Essentially, make sure you're done working. Because if all of a sudden, and you might say, yeah, sure, I'm done. And then a year after, someone approaches you and it's a quarter-time appointment or a half-time appointment, or you got bored or whatever, and you go back to work, now, you know, you kind of are pinned into a position where you're losing so much money by what you have to pay back to Social Security that even though you really would like to work, you're kind of forced into a position where you can't financially. So just be aware of that. Qualified charitable distributions. We'll go over this again because I don't know how many new people we have on this for this one, but QCD, it's a direct transfer of funds from your IRA custodian. So it's paid directly to the qualified charity or church. So any charity counts, but church specifically in this case. And it's counted towards satisfying your required minimum distribution each year. It's not included on your taxable income on your tax return. Certain rules are met. So one, you have to be 70 and a half. Okay. And also the 70 and a half, which I didn't clarify before, 70 and a half means 70 and a half. It's not the year you turn 70 and a half. If you are 70 and 1 day short of a half year, that does not qualify. Okay. So you have to be really careful to know when your birthday is, make sure you're halfway through and say your birthday was, January 1st. And so you just have to get halfway through the year. If you're used to, giving to the church maybe on a monthly basis, you might want to just say, you know what, I'm actually going to hold off on the first 6 months and then I'll just do a lump sum in the second half of the year just to be able to utilize this strategy. Okay. The distribution has to go directly to the qualifying charity, so you can't have the money come to you first. The maximum annual amount is 100,000. And in order to qualify for this year's RMD, required minimum distribution, the funds have to come out of the IRA by December 31st. So the reason why we notate that is you can't do it like February and still have it apply on this year's tax return. There are certain things that we can do, like you can make an IRA contribution and have it all the way up until April 15th and still have it qualify as a deduction on this year's tax return. But when you're taking money out, it's got to come out prior to year end. This was just the scenario of these tax return examples. So for IRA pension in this example, we just had 55,000 on line 4 of IRA's distributions. And the assumption here is that you just wrote a check of $6,000 to the charity, but you didn't get any benefit because here's the standard deduction is 27,000. Well, the 6,000 wasn't enough to bump you up and over that, so you're not actually getting any benefit for it. Your total tax at the bottom was 9,900. However, if you would have had it come directly from the IRA, we don't have to worry about it being an itemized deduction or standard deduction. That comes out of it entirely because we subtract it off from up above. So the 55,000 gets subtracted down to 49,000, taking 6,000 off. Now your taxes bumped down to 7,400. So saved about $2,500 on a $6,000 contribution. So pretty significant. I do have just a list of like common questions that we get. So a little bit of like just a frequently asked questions section. So what happens when the retired clergy passes away? So this is a good reminder that first of all, I guess the question is, what happens in the year that they pass away? Can the allowance still be claimed for that year? And does it matter when they die? Is the allowance lost to the spouse as soon as the person dies? Okay, so the answer is yes. It's very short there, but yes, it can still be claimed in the year of death. The catch there is that you have to actually match up activities with when they happened. Okay, so the amount designated for the year, first of all, is irrelevant. The entire account was designated, okay, up until they passed away. Once they pass away, you do lose the benefit going forward. So it's kind of the date of death is going to be that's where you lose it going forward. So However, if say the normal amount that they spend each year is $30,000 a year on housing, and the pastor passes away in June. It's not that like they're limited to 15,000. They don't get necessarily a half year. They could do 30,000 if they spent 30,000 in the first half of the year. First half of the year, the full account was designated, so that's not an issue for the, so the issue there is you do get a prorated amount for the fair rental value. So the fair rental value is going to be kind of on a monthly basis, really what you're looking at. So depending on what the fair rental value is, that might throw a wrench in things for you. But the biggest thing to remember in this scenario is if this happens and the clergy passes away, you lose all the housing and benefits. And if they had a spouse, that spouse is kind of got hit by two things. One, they now are filing a single tax return the year following. Okay. So it's making sure that your estimated payments are kind of in line with where they should be for the following year. But on top of having to file single, which means they get a lower standard deduction, their tax rates might be higher depending on how their income falls and everything. They also lost the housing benefit. So they're kind of getting hit a couple different sides of benefits that they're losing when that happens. So it's typically, I would just say the importance there is making sure you do some estimates so you know where you stand with everything. It's not the end of the world. Yes, you have to pay some more taxes, but what feels like a little bit more of the end of the world is when you're used to paying $3,000 a year in taxes, and that's what you pay this year. And then all of a sudden you come up the next year of taxes and you have a balance due of $10,000. Like now, and you weren't expecting that, you know.
I hadn't thought about this before because we're both clergy. But so if
We got a mic incoming.
Actually, I have to follow through.
Okay. With the estimated payments, I hadn't thought about this before because we're both clergy, so we just have to do that. But if the clergy spouse dies, the non-clergy spouse still has to do estimated payments, or how do they?
They can do estimated payments or they can do withholding.
They can have West
Yeah.
Bath do withholding on their.
You always have the
pension
option
payments.
you always have the option to either do estimated payments throughout the year where you're writing a check or making a payment online 4 times throughout the year, or do withholding. Withholding, you do have to have a source where it's coming from.
Right.
So if that source could be Social Security, that source could be Westpath, where they're withholding. It could be from a separate IRA that you have. Sometimes if you're doing withholding, it feels kind of painful because you might just be saying, hey, I just want to handle withholding out of like one source.
Yeah.
So say, I have plenty of individuals who their tax for the year is $10,000. So what do? They don't need their IRA money to live on maybe. So they're living on Social Security and their pension. So then every year they just do a $10,000 distribution from their IRA, but they have it set at 100% withholding. So it's just, they basically are just making a payment directly out of their IRA for their taxes. Then they don't have to do the 4 payments throughout the year. And then I have other individuals who prefer to make the payments. It's just like, they're used to it. They've done it their whole life. The estimated payments are their routine. So it's really just personal preference on how you want to make those payments. Another kind of, so this question continued, but basically, yeah, we already answered this one. So it does matter when the pastor dies, because that's going to determine how things are kind of prorated, or what have you spent up to this point. But nothing's ever really directly prorated other than the fair rental value. That one is prorated, but everything else is going to be, when did it actually happen? Yep. I was just seeing if there's anything else in there. I was just reading it. So, okay, movie and reimbursement. I guess we never did this one in the last session, but movie and reimbursement. When you're retiring, you're allowed one last move when you retire that the conference is going to pay for. You'll get a 1099 for that at the end of the year. So just be aware of that. It is reported as miscellaneous income on a Schedule C and subject to self-employment tax. So Gene and I have gone back and forth on this for the last 5 years now or something, it feels like. And there was a number of changes. This doesn't seem right that it's subject to self-employment tax. It doesn't seem right that you have to pay tax on it because it's a reimbursement of moving expenses. And it all goes back to the Tax Cut and Jobs Act in 2018. Eliminated moving expenses for everybody. So this did change, but this wasn't like a specific change to clergy. It was no one can deduct moving expenses anymore. Okay, so that.
So they know that if they're moving out of state, they're limited to $4,000.
Okay, and then if you are moving out of state, you are limited to $4,000 for reimbursement as well. Okay, withholding, we just kind of talked about this, but this is just kind of my recommendation. In the year of transition, you kind of have a half and half year of, normally you're done July 1st, right? And so I normally just say, keep doing estimated payments just to keep it simple rather than trying to blend like withholding with estimated payments. Once again, your situations are all different. So maybe it makes sense for you to do everything through withholding. But after that, I mean, I just say, hey, it's your preference. You can do withholding, which is kind of set it and forget it, or do estimated payments, and you just need to remember to make those. But they're easier to adjust, estimated payments, because what do? You just change the amount that you write on the check each quarter if you need to adjust it. If you change withholding, well, now you got to get a form, fill it out with Social Security or fill it out with Westpath, just notify them of a change. So it's just kind of up to you and your preference. That's it. That was short and sweet. So anyways, do we have any questions? Any time is it?
Nothing online.
Did anybody make it through the whole way, or is there just no one online anymore?
7, just went down to 6.
Yep. So big thing. I would just emphasize more than anything, especially in the year of transition, is just see if you can find someone to help you out with, find a tax professional that's near you. A lot of times these things are easier to do in person too. So if you find someone in your area, go, bring your whole box of finance stuff, whatever it is, have them help you sort through what you have in the year of retirement. Kind of as you're vetting CPAs that you might work with, just obviously, I think you all know pretty well, but it's like, just ask them if, they've worked with pastors before and if they're familiar with that tax code. Ask around to other pastors that do you have someone that you like working with, that kind of stuff too. I would say in general, I've worked with individuals that I've never met, like in face to face, and it works just fine. I think it's up to the user as far as how you want to, whether you like doing Zoom meetings, whether you like just doing phone calls. I feel like you have to be a little bit more diligent on your side if you're going to do it in a virtual manner. You got to make sure that you're asking all the questions, be as neat and orderly as you can. If you're sending a whole bunch of documentation to someone, it's make sure that you are having a nice cover letter that kind of explains everything and asks all of your questions and just lay it out all nice and orderly. So that'll be my biggest recommendation though. So that's all I have.
Thank you.
Thank you so much, James. Appreciate you being here. Again, if you have any tax specific questions, ask a tax person near you. WUMF does not have your answers. Gene does not have your answers. So find the person near you. We thank James for coming, but don't call James. This was his opportunity to be with you today. Find your person near you. And we thank you all for that. If you have any questions about endowments or grants or scholarships, you can call WUMP for that. We'd be happy to give you all the information on that. And with that, we thank you all for being here, and we'll see you next time.